While the economic indicators for the U.S. economy are currently strong, not all agree on the long-term forecast. Christine Lagarde, the International Monetary Fund Managing Director, says while the clouds are getting darker every day over the entire global economy related to trade tensions, the IMF forecasts the U.S. economic growth will not only slow this year as the impact of tax cuts fade, but will be at a mere 1.4% pace by 2023. That level is, of course, much lower than the Trump administration has forecasted, with sustained economic growth of 3% within 5 years. Here to help us assess the economy in light of the U.S. Federal Reserve's raising interest rate decision this week is Jeffrey Small, the president and founder of Arbor Financial. Jeffrey, thank you for being with us at the end of the week. We sure appreciate it. A lot of folks expected the interest rate increase, but there was more news from the Fed that they forecasted they're going to do several more interest rate hikes during the rest of the year. What's your take?
Well, they've increased the Fed funds rate 7 times since 2015, and the economy's on fire right now. I mean, the government's spending $100 billion a month more than it collects, and there's hundreds of billions of dollars pouring back into the United States because of the Trumpian economy, Bert.
Yeah, they have done a good job. There's no denying that the economy is pretty much on fire in a good way, and balancing that at the Fed has been, they've done a good job overall with both Chair Yellen and now with Jay Powell with regard to interest rates. Jeffrey, the Consumer Price Index came out this week showing that it had the increase the fastest in 6 years, the fastest pace in 6 years, and overall U.S. retail sales were the best in the past 6 months. How are consumers going to react to interest rate hikes and things like housing, where we saw new construction increases back in April, and on other major purchases like automobiles or trucks?
Well, sure. Well, we're going to see, Bart, in the future here, in the short-term future, we're going to see things like mortgages and credit cards and car loans actually start to have to charge more because interest rates are going up. And so the current threshold really for construction and new homes really is around 6%. When we see mortgage rates hit 6%, we kind of hit the wall. Today we're at around 4.5% on a 30-year mortgage. And so right now it's just kind of a pinprick to the average consumer's pocket. As we saw yesterday, consumerism is running rampant. People are spending more than they have in years.
If you were advising maybe your customers or even your neighbors, Jeffrey, that are thinking about buying a house within the next year, would you say buy now?
I absolutely would say buy now if they're going to be in the house for 5 years or longer. If they're not going to be in the house for 5 years or longer, then they really need to wait until the rate cycle peaks and see if actually the market starts to correct a little bit here over the next 12 to 18 months.
Very interesting. And how do you think that this, you heard my headline maybe about all the trade and tariff war talk going on. Do you think there's going to be an ultimate impact on the economy? I guess it's a little bit too early to tell right now, but what are your thoughts?
Well, we're really not seeing the effect of the trade war in the general economy yet. It's going to be really a pinprick in the short term, but we see the stock market starting to react. And today the Dow was down on the major market indexes more than any of the other ones, and so I suspect that will occur. But where United States people will get hurt is the farmers, because we export so much farming products to China. That's really where the tariffs are going to be here in the short term until we see what happens in the long term.
And what do you think are some of the other economic indicators that we should be looking at vis-a-vis the economy now, and what should we be looking at in the next few months that might be indicative of growth throughout the year?
Well, I think the stock market really has a really good idea on our good pulse on what will happen with the economy going forward. If the market tends to drop, that'll dampen consumerism. If the market keeps expanding, that will increase consumerism and will keep increasing debt, even though we seem to be hitting debt peaks at this point in time, Bart. I mean, yesterday we hit a global debt figure of an all-time record of $237 trillion globally, and a large amount of that is domestic debt as well. And so we're coming to the end of the debt cycle, so consumers want to be aware of a potential debt bomb at some point in the near future.
Jeffrey, we really appreciate you being here at the end of the week. Thank you so much. You're always informative for our viewers. Jeffrey Small, president and founder of Arbor Financial, thank you for being with us.
Thank you, Bart.